In today's video, I'm going to talk about how you could spend or invest your first $10,000 on the stock market. So for your first $10,000, of course, this is going to be what you want to be safe investments. You don't want to have any random bets in most cases. If you can afford to lose 5 or 10 grand and it's your first 10 grand to invest, then I'll go all for it. But I'm going to tell you right now, for your first $10,000, you want to be safe, and I suggest in Canada to do it with a TFSA, a tax-free savings account. The reason for this is, of course, depending on your age, you can have upwards right now of $76,000 in that account, and whatever gets grown in that account, whether from appreciation or from dividends, is totally tax-free. So that is a great way to start investing, at least here in Canada. But let's get down, let's check out a couple of different options that I would suggest personally. But always do your own homework, never trust a random YouTuber. So the first ETF I would suggest is XIU. Now on Yahoo Finance, currently they are having a glitch and everything is not applicable, so let's switch over to their website really quickly, the iShares website. So as of right now, it is trading at $30 per share, and year to date, it is up 17.7%. So if you invested basically January 2nd or January 18th in this case, then essentially you would be up 17%, which would be around $1,700 on $10,000. And if you did it inside of a TFSA, you would be able to do that all tax-free. So XIU is an iShares S&P TSX 60 Index ETF. What does that mean? So basically an index fund is a fund that will allow you to hold stocks in the generalized index that it's currently covering, and this one is covering the S&P TSX, which is essentially covering the whole Canadian market, and that 60 means that it's the top 60 companies in the TSX. So a few things that you really want to pay attention to is, of course, do they pay a dividend and how often? And here we can see that their distribution yield is 2.58% for the whole entire year, and then its distribution is quarterly. So essentially, let's say, for example, you're getting 20 cents for each distribution. Throughout the entire year, you would be making 80 cents per share. And if you had $10,000, you would be roughly around 333 shares of this ETF. So you would make about $266 per year on the dividend alone. Something else you really want to pay attention to in ETFs is their management fee. And of course, their MER, their total management fee, is 0.18% for this ETF, which isn't too bad. Compare it to a mutual fund, which is what most people get sold on, which is about 2.1% in most cases. You are saving a ton of money by investing in an ETF yourself instead of allowing a bank to invest you into a mutual fund. Because for $10,000 in a mutual fund at 2%, what you would be basically giving to the bank would be about $200 a year, where in reality, what you would be looking at giving to them is instead $18. So that's a massive difference, and you would be saving about $182 a year on management fees, which in the long term is a huge sum of money. You also want to know their holdings. Their top 10 holdings is very important because, of course, that's the heaviest part of what the ETF holds, and you want to see if it's solid companies for the future. And of course, this one is going to be listing them off basically the same as the actual stock market itself. So the biggest company in Canada is Shopify, second biggest is Royal Bank of Canada, third is TD, and it keeps on going down to Enbridge, Bank of Nova Scotia, National Railway, Brookfield Asset Management, Bank of Montreal, CIBC, and then Canadian Pacific Railway. So pretty solid companies overall in this ETF because, of course, it is the TSX Index ETF, which means that you are investing essentially in the top 60 companies weighted to the size they are on the stock market, and it's just a great investment overall, very safe investment. And then at least on Yahoo Finance, they do show still today the historical dividends. So what I like to do as well is looking in the past, and I like to say, okay, well, May 2018, let's see, May 2018 to 19, there was a little bit of an increase. From May 2019 to May 2020, there was again another increase in dividends. And then, of course, there was a small drop-off this year. But again, we are currently going through coronavirus, so I'm not really too worried about a 1 cent drop-off in dividend year over year. And this is their chart. Of course, you want to look at the chart, you want to see the progression, their history. Of course, whatever happens in history is not going to be set to repeat itself, but at the same time, we can look at the charts and see where it's been going, where it's been, and of course, being a TSX index ETF, essentially it's going to be tracking is pretty well exactly where the stock market is moving. The other thing with index funds is you are essentially investing in so many companies that if one company fails, you're not going to have to worry. Basically, it's a very safe way on investing, and over time, it's like an average of 5 to 8% a year when you're looking at a TSX index or even an S&P US index. 5 to 8% a year on average over the past 50 to 100 years. You can kind of see how much money you're going to make over time. The second option I would say is a great option is XIT. On the Canadian Stock Exchange, it's the iShares S&P TSX Capped Information Technology Index ETF. Again, this is an index ETF that is going to be covering information technology of companies that are on the TSX, and it's capped to a point where what that means is they are the biggest companies are capped to a certain size, and you would have to read into each different ETF that says capped on what their cap amount is. The other thing you really want to watch out for is the average volume. Now, 46,000 average shares traded per day is going to be an easy ETF to get in and out of. The expense ratio on this one is a bit higher at 0.6%, but again, you're now looking into information technology. You're looking at something that is going to be a little bit more actively managed. The more management is basically needed, the higher the fees are going to be. By the way, there is no dividend on this one. This is just purely a growth play, and it's a little bit more riskier because it is more of a growth play. It is in a singular sector, being information technology. But again, you can see the massive growth over the past 5 years. And of course, the biggest companies when it comes to information technology in Canada, Shopify is a massive one. We've all heard of those. Constellation Software is another big one that a lot of people have also talked about. OpenText is talked about a ton on BNN and things like that. BlackBerry is obviously BlackBerry. And then all of the rest may not be as big of household names, but it's always good to click. If you go into Yahoo Finance and figure out which ETFs that you're looking at, and if you can click on these links here, you can actually read more about those individual companies and if they suit your investment wants and desires and needs. Now, this is turning into one of my favorites. TXF is essentially a tech index, even though it's not an index fund. It's going to hold tech companies, but this is a bit different. It's a covered call strategy, which is again a little bit more riskier, but still safe, being that it's covering a ton of different stocks. Now, options is something that's hard to explain in a video talking about ETFs and easy ways to invest, especially if you're a beginner investor. So from there, I would definitely, if I were you and you don't know what a covered call strategy is, definitely Google that and see what it is. And if I remember, I do have a video that is on my channel. I should tag that up top if I remember to do so. And then from there, again, higher volumes, but what you're getting here is a growth story, but also high dividend. This is 11.4%. So if you were to invest $10,000 into this ETF, with the dividend alone would be a massive $1,146 per year as a dividend, and this one does pay out quarterly. So that's a massive amount of money, which if you were to have that in a TFSA, that is essentially, if you want to round off, about $100 a month tax-free. So if you were to go and have some hard times and you had some savings still in cash, you lost your job maybe, then at least $100 a month is something coming in, and at least at that point that could supplement your wage that maybe the government now pays you because COVID, maybe you lost your job, things like that. If there's a new version of COVID that comes out and they lay everybody off again, at least $100 a month is something on average, even though it pays every 3 months. At least least it's something. This one's MER is a bit higher at 0.71. And of course, the chart looks pretty good. It just recently had a massive double bottom over quite a few years, which some people don't look at that, but I actually personally do. Essentially, it did trade sideways for a while. It did have some nice growth. It's going into growth time again. Will it trade sideways? It sort of looks like it might. It did have a double top, which is kind of curious, but again, it did accelerate past that double top again. Usually when there's a double top, it does tend to travel downwards. However, it's going against the grain. This is why you should never always pay attention to history and always do your own due diligence. We also want to see improvements over time. So let's say we go June to June, 2019 to 2020. We are now looking at a massive dividend growth. We also want to say, well, let's see. What about the most recent one, 2021 March to 2020 March? We see another massive growth of dividend. This is a type of thing that you would want to see. And the top 10 holdings that it has is NVIDIA, Applied Materials, Alphabet, which is Google, Oracle, Intuit, Adobe, Facebook, Salesforce, IBM, Microsoft. IBM is the only one that worries me, but at the same time, pretty solid companies in the top 10. So I hope that this gives you some ideas on how to invest your first $10,000 in Canada. If it does, hit that like button, subscribe, and I'll see you guys again next time.